What is the Dodd-Frank Act and its impact on finance? Imagine a financial landscape where transparency and stability are prioritized to protect consumers and prevent economic crises. This vision became a reality with the enactment of the Dodd-Frank Wall Street Reform and Consumer Protection Act. Signed into law in 2009, this comprehensive legislation was a direct response to the financial turmoil experienced during the late 2008's economic downturn. Its primary goal was to reduce risks within the financial system and to shield consumers from unfair practices. The Act introduced a wide array of reforms aimed at increasing oversight of financial institutions. One of its key components was the creation of the Consumer Financial Protection Bureau, an independent agency tasked with overseeing and enforcing consumer protection laws. This agency works to ensure that consumers receive clear information about financial products and are safeguarded against deceptive practices. The legislation also established the Financial Stability Oversight Council, a body responsible for identifying systemic risks that could threaten the entire financial system. In addition, the Dodd-Frank Act imposed stricter capital requirements on banks and financial firms, requiring them to hold more reserves to withstand economic shocks. It also introduced new regulations for derivatives, which are complex financial contracts often associated with high risk. These derivatives, previously less regulated, became subject to transparency and reporting standards to prevent hidden risks from destabilizing markets. The impact of the Dodd-Frank Act on the financial industry has been significant. It increased regulatory oversight, making financial institutions more accountable for their actions. Many large banks faced stricter rules on their trading activities and capital holdings, which aimed to reduce the likelihood of another financial crisis. The Act also empowered regulators to dismantle or oversee institutions deemed too big to fail, thereby reducing the risk of taxpayer-funded bailouts. Furthermore, the legislation fostered a culture of greater transparency and consumer awareness. Financial institutions now provide clearer disclosures, helping consumers make better informed decisions. While some critics argue that certain regulations may limit financial innovation or increase compliance costs, the overall effect has been a more resilient and transparent financial environment. The Dodd-Frank Act remains a cornerstone of financial regulation, shaping how markets operate and how risks are managed in the modern economy.